We've been talking about investing in women's sports here in Houston at the Chevron Leadership Initiative Co-Mission Champions of Women in Sport event. Also in just a couple of days, the Chevron kicks off. It is the first of the major championships on the LPGA Tour. Joining us right now is Chevron CEO Mike Wirth. And Mike, it is great to see you. It's great to be here. Before we talk women's sports, I want to talk about the business of the markets today and what we're seeing. And I think the biggest issue people are watching in your industry right now is the price of oil. WTI below $64 a barrel. It's getting dangerously close to $60. I just wonder if you think this is because of what's happening in the economy and the drop in demand, or if you think that this is more of an issue of the extra production that's coming on from OPEC Plus, or both?
Well, first of all, it's great to be here with you, Becky, and really appreciate you being here for our big event. It's a little bit of both in oil markets. There's been an expectation for reduced demand as a result of some of the reaction here to the tariff and trade issues that we've seen, and that's been matched at the same time by a decision from OPEC Plus to start to bring production back into the market faster than they had originally indicated. And against that backdrop, we've got growth in some non-OPEC countries around the world as well. And so you're seeing, at this point, probably more an expectation than any data that would say the reality that demand is slowing and that supply will be growing at a rate that's different than what the market had previously been priced in. So prices have come off into the 60s, and we'll see where they go, I think, in response to how both of these things evolve in the coming weeks.
How does that volatility and the lower prices for oil, how does that impact your CapEx, your plans for capital expenditure spendings?
Well, in a commodity business, we have to always be prepared for uncertainty and really in our business for the risk of a down cycle. So you maintain a very strong balance sheet. Our balance sheet, we've got lower debt than we historically have carried. We're AA credit. We actually reduced our capital spending by $1 billion a year coming into 2025. We also announced $2 to $3 in cost reductions that we intend to deliver over the next 2 years. And that, at a $70 oil price, along with some growth that we've got in our business, leads to $10 billion of incremental free cash flow growth over 25 and 26. And even at a $60 price, that's at $70, but at $60, we expect $9 billion in free cash flow growth. So capital discipline, cost discipline, and balance sheet strength are fundamental in a cyclical commodity business, and that's how we've got our company set up.
But will lower oil prices impact how much you spend on exploration this year?
You know, our spending is really geared towards a longer-term view on prices. And short-term, we've got to deal with volatility in markets, but we can't really swing our capital spending based on the price of today. It has to be based on our view of price out into the future. And our fundamental views on longer-term supply, demand, technology, policy are really unchanged, and so our longer-term view of prices are what drive our capital spending.
Does that mean you don't think we're headed into a recession in your plans at this point?
You know, there's no signs that we see at this point that we're in or close to a recession. There are signs that growth may be slowing, and again, we have to always be prepared for that. But ours is a long cycle business. The capital we put to work in our business isn't there for just a few years. It's typically there for decades. So we really have to take a longer view and not get buffeted too much by short-term market movements.
Although even those longer-term plans, things can get upended. I'm thinking of Venezuela, where you were doing production and the Trump administration has now ordered you all to withdraw from that by May. Was that a huge surprise to you? What does it mean longer term?
Well, the first priority for us in Venezuela is the safety of our people and protecting the environment. We've seen sanctions in place on Venezuela from the first Trump administration through the Biden administration, and now again as President Trump is back in office. The terms of those sanctions have evolved a little bit over time as the U.S. pursues its policy objectives. So we work closely with the Department of Treasury to understand what they're trying to achieve and make sure they understand the potential unintended impacts of some of the changes. And so we'll work with them to understand the rules and then inform them of how we can continue to keep important supply flowing to the United States, which our refineries in the U.S. actually need.
Is that to say that you are in discussions with them still, or at this point to try and extend because I think it was May you were supposed to be out of Venezuela.
May was a wind down on crude oil sales.
Okay.
And then there are other terms that, we've never been through this period I've described over the last several years, actually in a position where we've been forced to leave the country, and we believe our presence there is good for the long term for the people of Venezuela. And so we'll work to try to maintain that position. We're the last American company still on the ground in this industry there. Others that have come in are from China, from Russia, from other countries, and we think it's important for America to have some representation in Venezuela for the long term.
How are your discussions going, not just on Venezuela, but with the administration in general? We had David Solomon on a little bit ago, and he was saying that there is a free flow of communication with administration officials, at least in his business.
Absolutely. That's what we're seeing. And, we deal with people like Secretary Burgum at the Department of Interior, Secretary Wright at the Department of Energy, two very well-qualified individuals for the roles that they're in, and frequent dialogue. They understand the energy sector. They're very engaged with business, and we see that across many of the other cabinet officials as well. So the engagement has been very good.
What do you feel about the messaging that gets out to the business community, I guess, with things like tariffs? I'm not sure the tariffs impact you greatly. Obviously, you have projects that are outside the United States, but are those impacted by the tariff discussions?
So we're not heavily impacted by tariffs, not certainly as heavily as some other industries are. Energy has been exempted from a number of the tariffs because of its vitality to our economy. And so the effects that we feel are likely to be more of the macroeconomic effects as they flow through the economy. Yeah. We are exposed to certain supply chains where we source goods and materials from other countries, but we're in a position to largely, I think, manage that pretty well. And so the bigger issue would be what does it mean for growth and kind of global trade and how does that evolve?
I think Joe has a question for you, too, back from studio.
Good morning, Joe.
Hey, Mike, it's just about the current environment and whether you really do notice any differences. There was a time when the majors were more interested in returning, it seems like, cash to shareholders, whether it was through buybacks or dividends or whatever. I think that all shifted, and now I'm just wondering, are you more comfortable with a 10 or 15-year capital deployment plan, or could it all change again in 3.5 years from now?
Well, first of all, I've got to say the policy messaging we've been getting for energy, I think, has been very helpful for the U.S. We've got energy resources that are unparalleled in the world if you look across the entire energy complex. And I think the administration understands that American energy abundance can underpin economic prosperity. It can also help with the electricity that's going to be required for the growth in data centers to support AI. We've got abundant natural gas here, which will be part of that solution. So I think we're seeing an approach that says we want to leverage this for economic prosperity, for energy security and national security, and we can work to reduce emissions and also, improve the environmental performance of the energy sector. So all those are good things. We've been around since just after the Civil War, and so we've seen administrations and policies evolve in our sector over the long cycle, Joe. And our capital allocation is really driven by our view on long-term fundamentals of supply, demand, alternatives, technology. And we deal with some of the shorter-term things that can come with political cycles, but it doesn't drive capital allocation to nearly the degree that I think most people would suspect.